Stop what you're doing. If you own NXP, or honestly any semiconductor stock right now, you need to hear this fundamental breakdown. Last week, I ran NXP through 5 valuation models and 2 legendary checklists, and what I found completely shocked me. Look, I know a massive fear for retail investors right now is that this entire tech rally is just a hollow AI hype bubble waiting to pop. But NXP, they are quietly generating more cash than 88% of their competitors, yet their stock is mysteriously lagging behind the broader market. It's like finding a Ferrari abandoned at a used car lot. By the end of this explainer, you'll know exactly if NXP is a screaming Warren Buffett buy or a classic Peter Lynch value trap.
To figure this out, I'm handing you a clear, actionable framework you can steal for your own analysis. We're running NXP through a strict 5-pillar setup. First, the NXP market position. Second, Q1 earnings and growth. Third, their free cash flow advantage. Fourth, debt and financial health. And finally, a sector and peer comparison.
All right, let's jump right into Section 1, the NXP market position.
Think about this number for a second. $81.7 billion. At an $81.7 billion market cap, NXP is an absolute titan. You know, when legends like Warren Buffett look for companies, they want those massive, defensible moats. And at this scale, NXP isn't just participating in the global tech ecosystem, they are literally the foundational plumbing that keeps the whole thing running.
Let's break down where that money actually comes from. Automotive completely dominates the revenue stream, pulling in a staggering $1.78 billion just this past quarter. Add in their solid pillars across industrial, mobile, and communication infrastructure, and you've got a highly diversified physical portfolio. They are building actual hardware for tangible, physical industries.
Moving right along to Section 2, Q1 earnings and growth.
So, NXP shares jumped over 25% following these recent Q1 results. CEO Rafael Sotomayor really hit the nail on the head here, pointing directly to momentum driven by software-defined vehicles and physical AI applications. Essentially, it's all about injecting real, tangible intelligence into next-generation hardware.
The real catalyst here was this massive 12% year-over-year revenue beat, hitting $3.18 billion. And when you pair that top-line beat with a highly profitable 57.1% gross margin and Q2 guidance that totally blew past Wall Street's expectations, well, you're obviously going to get a massive market reaction.
Now for my absolute favorite part, Section 3, free cash flow advantage.
Just to make sure we're all on the exact same page, free cash flow yield is crucial. It tells us exactly how efficiently a company generates actual, tangible cash relative to its overall size. It's basically the cold, hard cash left over to pay dividends, buy back stock, or reinvest after paying down all those operating and capital expenses.
For NXP, their trailing 12-month free cash flow yield is sitting at a very, very healthy 4.66%. Now, on its own, sure, 4.66% is a solid indicator of a cash-generating machine. But to really grasp what this means, we got to put it into perspective.
In context, that yield absolutely crushes the competition. NXP sits in the top 12% of the entire semiconductor industry for cash generation. It beats 67% of the tech sector and 63% of the entire stock market, all backed by a super consistent 5-year historical average of 4.68%. That is serious financial power.
Okay, let's look at Section 4, debt and financial health.
Cash flow is awesome, but we use the debt-to-equity ratio to really understand a company's financial leverage. It shows us if they're actually funding their growth responsibly. A lower number means less risk, while a higher one means they're heavily relying on borrowed money.
Digging into the data, NXP is operating with a debt-to-equity ratio of 1.22. That's derived from roughly $10.97 billion in long-term debt against $10.06 billion in shareholders' equity. For a highly capital-intensive sector like semiconductors, this, especially when paired with a comfortable current ratio of 2.05, signals a really strong and responsible financial footing.
Finally, let's wrap this up with Section 5, sector and peer comparison.
Head-to-head, NXP's cash-generating power literally leaves direct rivals in the dust. I mean, think about ON Semiconductor at 3.04%, or Microchip Technology trailing way behind at 1.76%. Compared to them, NXP is an absolute cash cow. If you're an investor prioritizing cash flow, the advantage here is just glaring.
But here's the catch. The data also reveals that despite these killer fundamental metrics, NXP stock is noticeably lagging behind the broader semiconductor ETF XSD. Over the year to date, NXP is up a very respectable 48.3%, but XSD? It's more than doubled with a 102% return. And looking at the 52-week time frame, NXP's 61.8% gain is totally dwarfed by XSD's massive 179.5% run. So yeah, NXP is winning the cash flow battle, but it's kind of losing the momentum war against the broader sector.
And we actually see this reflected in the analyst sentiment too. We've got a moderate buy consensus across 29 analysts, but the current trading price is actually sitting a bit above the mean price target of $303. This tells us that while analysts really like the fundamentals, they might feel the current stock price has already baked in a whole lot of that good news.
Which brings us to the ultimate question. With rock-solid fundamentals and industry-beating free cash flow, but lagging price momentum, what is the broader market seeing that we aren't? Is NXP an undervalued cash machine just biding its time, or a mature giant struggling to keep pace with the hypergrowth of its peers? The data is all right here, but the final decision is yours. Thanks for joining me on this explainer, and I'll catch you next time.